Well, hello and welcome to the Iris Medic podcast. Today, we're going to be talking about something that is a common theme that we find that there's a lot of tax academics who will always say crazy things, crazy, insane things. And this is actually our reaction to something that a couple of tax academics claimed about a particular type of tax. John, this is the mandatory repatriation tax. You want to give a little brief synopsis on what the MRT is, or otherwise known as transition tax, that these academics think are fine? Is actually they're fine with it. They don't see a problem whatsoever with it, likely because they're not impacted by it. So it's a lot easier to think something's fine if it doesn't bug you, right? Hey, no problem at all. I'm fine. My tax return is pretty simple. But for those who have shares in foreign corporations, might be a little bit difficult. So what is the MRT? How does it work? What's it all about?
Yeah, so we've actually done a number of, for long-term listeners or consistent listeners of this podcast, we've done a number of discussions of it. This is really what the Moore case was all about, the Moore appeal. And essentially, this goes back to the 2017 Tax Cuts and Jobs Act. And it was essentially a law that required shareholders of foreign corporations, specifically controlled foreign corporations, to put on their own tax returns income earned by those foreign corporations, even though it had never been distributed. So, in other words, it was essentially a deemed realization of the income of the corporation, or as I would put it, fake income.
Fake income. Yeah.
Attributed to the shareholder.
Right.
And we've done all kinds of podcasts on this, and so listeners would know what our view of it is. But interestingly, like everything in U.S. law, when it was drafted, there were carve-outs drafted, and the carve-out was for shareholders of what's an S corporation, right? Which is essentially, if you get a bunch of individuals together and they're shareholders of a C corporation, they can designate it. It's a tax designation as an S corporation, which basically means that it becomes a flow through, et cetera, et cetera. But the bottom line is that the statute itself had an exemption, if you will, from the transition tax, aka MRT, for S corporation shareholders. And of course, they didn't know about, well, some of them may have known about it in advance, some not, probably not, because most small business people are more interested in just trying to run their businesses. But, and sort of playing the blame game and trying to make it seem like this was not a big deal, there were certain people who actually took the position that any individual who was subjected to the transition tax, it was their fault. It was their fault.
That's right.
Well, they could have created an S corporation too. And of course, that suggestion is bad enough, when it comes to U.S. residents. But then to apply it to Americans abroad is borderline insane. And as a suggestion that can be made only by, in my view, people whose minds and understanding are so disconnected from the reality of small business that it's just sort of, operating in some kind of a fantasy land. So, this was the result of, various tax academics taking this position. In other words, to be clear what the position was, okay, to be very, very clear. Are you ready for this? Any U.S. citizen living outside the United States who was impacted by the transition tax and was required to basically turn a percentage of their net worth over to the IRS, it's your fault, buddy. Your fault. Because you should have known about this retroactive legislation in advance, and you should have reorganized your non-U.S. corporation as an S corporation to avoid this. It's your fault. Well,
And it is utterly hilarious. These people are supposed to be experts in taxation. And they're talking about tax planning retroactively, that you don't know when a retroactive, and that's really one of John's strongest arguments on the Moore case. Like, look, this could be repealed on retroactivity alone. that it was a retroactive tax. And just to clarify, just to sort of underline what it actually is about. Imagine let's assume that the transition tax, or MRT, applies to U.S. corporations. Okay, let's say that you have shares of Apple, and Apple has given you some dividends over the years, but really they're hanging on to most of that money for acquisitions and other things that they want. Well, what the transition tax would do is like, well, okay, well, we're going to take the money that Apple is hanging on to for acquisitions. We're going to say it's yours, and you got it. Yeah, you didn't get it, and it's not yours. It's actually the corporation's, but we're going to tax you on that anyway. And that's what the MRT is, and it's very clear what it is. And so you guys, you, Karen Alpert and Laura Snyder, wrote this article, and we'll go through this, and that's what we're going to go through today. Here it is. I should have put the screen right on here. Here are the heroes. Here are heroes of taxation. Here's Karen, John, and Laura. Really, I'm so privileged to be able to have these people on as guests. Their knowledge and their depth are unparalleled. If you're really looking for the truth, these are the people to get it from, who deal with people on the ground. And speaking of which, Keith is unable to join us today. He had a family emergency pop up. And we know a lot of people from his group are joining us here. And if you are joining us, you might want to head over to Keith's Facebook group, American Expatriates here, and just join, because we get a lot of there's a lot of discussion going on about this. So here we go. We have the article here, John. This is just amazing. I'm so glad that you Karen and Laura did this. And just to give you some background, Karen is the founder of Australian-based advocacy group fixthetreaty.org. John Richardson is a Toronto-based lawyer who assists individuals who are tax residents of both the United States and their country of residence. Laura Snyder is a Paris-based lawyer and advocate for taxpayer rights, who's a member of the board of directors of the American Association of American Residents Overseas, and former international member of the Taxpayer Advocacy Panel, a federally advisory board committee to the IRS. All three authors are founding members of the Stop Extraterritorial American Taxation, seatnow.org. You can go there, join there. In this article, the articles demonstrate that the mandatory repatriation tax affected more individuals than multinational corporations, as they explain why the use of S corporations is not a viable option for most small business owners living and operating outside the USA. So here it is, right? And then this is, you bring this point, John, and this is, you guys bring up this first point. The Moore case has garnered a lot of attention, right? I mean, 43 amicus briefs, 22 in support of the petitioners, 18 in support of the respondent, the U.S. government, and 3 in support of neither party. And there have been just myriad articles discussing the possible ramification of any decision by the Supreme Court and more. And we have done podcasts on this where, yeah, we think there would be significant either way. And that's where we've said, it's actually hard to say this is the most important Supreme Court case of all time, because this year there seems to be the most important Supreme Court case of all time all over the place. There's a tremendous amount of activity going on with the Supreme Court. Loper Bright may overturn the Chevron deference. I did a video on that yesterday. And we have a First Amendment case, which is the oral argument was on yesterday, where I guess the government has an interest in regulating speech that we need to take impact of or take concern of. So there is a lot of there's a lot of things going on here. Now, this is now who are should we mention who these tax academics are? And I think you mentioned them in the article, and kind of what's their background of this? What are they saying?
I'd like to give people an incentive to download and read the article. So let's
All
not
right.
mention them by name.
All right.
It's in the article.
All right. And you know what? I'm gonna put the article in the super chat right now. So if you're looking for a link to it,
if you're this article,
so you can download it right there. That link that I just put in the super chat, you can go there, download it. That's what I'm looking at right now. So yeah, we don't want to go and I guess call people out. It's in the article, and their names probably will pop up while we're reviewing this, but we're not going to dwell too much on it.
But I mean, I would say this, Anthony, that they're the members of the group who had the courage to raise their hands and say what they really think. I'm sure that there were many others who agreed with them. So really, I think they ought to be commended. So if you want to learn about tax academics with courage, yeah, by all means, download the article.
Yeah, yeah, and I would say, and that's right, because I think it's, if you meet one tax academic, you kind of met them all. There's sort of a monolith. They're going to come down one way, and that, hey, any tax is a good tax as long as it doesn't affect us.
Well, I think they should be called Treasury's warriors.
Yeah,
Treasury
right.
warriors.
They're out there selflessly demanding that you pay taxes that won't impact them. And I think maybe this is a place where we were this chart. I love what you guys did here. I love what you guys did here because
Not me. That was not me. I want to make it very clear. Okay, that was actually, I think, Karen Alpert.
wow. She's brilliant. Yeah, she's really brilliant.
And a number of people have commented on the chart, but here's what the chart demonstrates. Okay, very, very well. I mean, first of all, all the discussion about the Moore case, and this is even though the Moores were individuals, by the way. All the discussion about this in the context of multinational corporations is as though individuals don't even exist. And I think for the tax academics that that individuals exist, it was a great surprise and discovery, possibly a seminal moment in their lives, and they're thinking about this problem. Okay. But the bottom line is this: that for the multinationals, I think that the transition tax, the MRT, was a very, very good thing. Why? Well, because, generally speaking, those earnings were going to be distributed to the parent corporation in the form of dividends. And, they got them out, they think in terms of cleansing those things, right? At a relatively decent tax rate. Okay. At a relatively decent tax rate. And the bottom line is that what the corporations got out of this minimally, right, was a reduction in their tax rate from 35% to 21%. So, it may be that, the rate they paid was higher than they expected, but it was still a relatively good deal. And what I find fascinating is I have never seen a representative of a multinational complain about this thing.
Right. We haven't had one advocate's brief in more. And by the way, as you're talking, John, I have to just say something here. This is part of the Tax Cuts and Jobs Act of 2017. Now, correct me if I'm wrong, John, because it was a retroactive tax, meaning the first and only year of the MRT is 2018. Is that correct?
Well, it was one or the other. There were complicated rules depending on where the year ended, but the income inclusion was either going to be in 2017 or 2018, probably 2017 for most of them.
So what we're talking about is a tax that is now, because it's not a yearly recurring tax, it was a one-time tax that they passed, that they got in there. So we're still just talking about this one-time tax that is currently in dispute of more. And I would imagine other people will be potentially looking for refunds if the MRT is strucken down, because a lot of people paid a lot of money for income they never received. Retroactive tax too. I mean, it's a combination of everything. It's a combination of everything terrible. And that's what's so difficult to understand about this. And this is something I guess I want to touch on now. When this came out myself, I was scratching my head trying to figure out what the transition tax was, because I'm looking at this and I'm like, wait a second, this seems like it's trying to tax the shareholders' equity of a corporation where the shareholder hasn't got that. And I was thinking to myself, you can't do that. You can't do that. You can't do this. And I'm like, I couldn't figure out this form because I'm like, this would be totally illegal. You can't possibly do that. Oh, well, no, I just didn't understand that they wanted to do something completely retroactive and illegal. That's what it is. So that's kind of one of the things. This is such a complicated law. And this is what I would say is that, well, who actually complied with the MRT? And John, I don't think that many people did, right? I mean,
I think that anybody who was, I think that the tax preparation industry basically said, well, you're in the system, we continue on, etc. I mean, a number of individuals made, 962 elections to mitigate it to some extent. But no, I think the compliance rate probably was very high. That's my guess.
Okay. All right. Well, I'm just saying there's a lot of people that
I don't know. I mean,
I guess, you know what? I talk to a lot of people around the world who aren't in compliance, and they discuss whether or not they do want to come into compliance or not. And this is another example of the person who,
the ones who were not in compliance at all, Anthony. I mean, I think it's a safe bet that, Anthony, who would be saying, well, I'm not in compliance, and oh my God, they passed this new law where they're going to confiscate a high percentage of my assets.
I better get compliance, right? Yeah.
I doubt it. Okay.
Yeah.
I think the people who were in the system probably did. I think that people just continued whatever their pattern of behavior was. That's my guess.
Yeah, probably. Yeah.
I mean, I'm not a tax preparer.
Well, and I would say I would say this, that the people who have been in compliance year after year after year are the people who got punished by this. Those who didn't get punished because, and this is really the thing, that who has been punished for not filing and paying a transition tax? And the answer, I don't think anybody has. I don't think anybody has. As far as I know, I haven't seen one case. Now, I guess, if an examination happens, we're not going to know. That's not public record. But there hasn't been any dispute whether or not this was someone who was detected. And I don't really know if this is even on the IRS's radar right now. If they began an audit of somebody, if the IRS began an audit of someone right now, typically your look back period is 3 years. What would make them go back to 2017, 2018 to say, is that the year even open? Possibly.
Well, it's foreign source income, right?
Yeah.
For starters, which I believe would give a longer. But, we can't know. I mean, I certainly can't know this stuff. I'm not a tax preparer.
Yeah, I did, right. And I would just say, I think that who this tax punished more is those in compliance. And so
absolutely.
And well, it gives it, and for those, the IRS wants people to come into compliance. Well, when you pull this stuff, people are patting themselves on the back to say, oh my God, thank God I avoided that crap. I mean, that's really what it is. And this is, this is so bad. So now we have this chart here.
The IRS, though. I mean, this is Congress. The Treasury Department constructed the regulations very punitively. But I mean, look, nobody likes the IRS, but let's not focus on them. They're not the problem here. Okay, this was a retroactive law and a very punitive Treasury.
Yeah. This was yep. So
I think what we need to do here while this is up is to show why, the treatment of individuals is very different from the treatment of corporations, right?
Yeah.
So, for the corporations, I mean, I'm sure they would rather have had the tax reduction to 21% without paying this.
Right. That would have been better, right?
Get something out of it for sure, right? Now, we moved individuals. Now, the Moors were individuals.
Right. And so this next column, you have individuals, U.S. resident, regardless of any
individual, right? And one of the things that's interesting is that they would have paid a higher rate of tax, than the corporation. I mean, let that sink in for a minute, okay? The corporations were paying 15.5%. The individuals were paying 17.54%. Without this sort of complicated 962 election, right? Also the individuals never got any reduction in tax rate.
All right, so here we have it's like, so foreign tax credit paid, the next line you have foreign tax credit for taxes paid by a controlled foreign corporation. It was automatic under section 960, but that's not something that can apply to an individual. There's
the way it works, I don't want to get this too complicated for listeners, right? But under section 960, corporations got an automatic credit or deduction, if you will, for foreign taxes paid on that income. I mean, so let's just imagine we got $1 million in retained earnings. Now remember, these are foreign corporations, which, surprise, surprise, other countries have tax laws, right? So the other country might have taxed that corporation by, say 15% or $150,000. Okay, now for a U.S. corporation, right, if that income is attributed to the parent company, they will get a tax credit for the amount paid by the corporation. That's what Section 960 is. But that
Okay.
applies only to corporations. As
Right.
a result, Section 962 was created, which was sort of, oh, yeah, it's unfair that an individual doesn't get a credit that a corporation gets. So, you know what? We're going to let an individual pretend they're a corporation, right, for the purposes of getting that credit. So essentially, that's what the 962 election is. Now, there are obviously a lot of different circumstances. A lot of individuals use the 962 election to mitigate the effect of the transition tax. However, that may not have been a good idea, because if you pay the transition tax, right, rather than use the 962 election, then the amount, let's say it's $1 million, that would have been completely taxed by the US tax system forever. Okay, forever. It would never be again taxed by the US if it was then subsequently paid out. But it would be taxed by the other country, right? So it sets it up for double taxation. On the other hand, if the 962 election was used, it's not treated as though the tax to the US has been permanently paid. Okay. So but that may have some advantages, right? Because if you then just do a distribution in another country, well, so you're taxed in the other country, but that sets up the ability to use a US tax credit, right? Et cetera. So, it was complicated, and I had a lot of discussions with people about this and how it related to their renunciation of US citizenship, where I don't want to get overly technical, but anyway, look, it's complicated, okay? And people had no time to understand this. One of the key points here is that this thing was just passed into law. Nobody even knew about it. Nobody had time to plan for it. Now, with individuals, living outside the United States, aka Americans abroad, it's 1,000 times worse. Why is it worse? Well, first of all, it's what those corporations represented to them. For many of them, it's their primary business, their livelihood, and possibly their pension. For the
Now,
more,
that was not necessarily true in the Moors, because it was a smaller investment, right?
actually, it was just an investment. It was just
Yeah.
part of their investment portfolio, right? But the point is that, on the one hand, multinationals got a sweet deal. But on the other hand, Americans abroad were destroyed. I mean, it reminds me very much of the OVDP program, right? Where resident Americans, okay, got a comparatively good deal. For Americans abroad to use that, it could have been a 50% confiscation of their assets, right? So this is extremely punitive for Americans
Now,
abroad.
now let me just back up here, John. Wait a second. So you're not just saying that there's differences between how the MRT affects corporation and individuals, but you're saying there's a vast difference, even depending on what kind of individual you are. That if you're a US resident, okay, it stinks, but it's not nearly as awful as if you're an individual who lives overseas.
That's
That's
exactly
what
right. That's exactly right, Anthony. You put it very well. I mean, it was like, who was it? It was actually, I think, somebody in, I don't know, some commentator said, put it this way: for Americans abroad, they use the word existential moment. I'm not sure what they meant precisely, but I have a feeling they thought it was incredibly serious. Okay. Uh, Et cetera. And it was. I mean, it was a pure confiscation of their assets, is what it was, right? And there were absolutely no benefits in this for individual Americans abroad. It was incredibly punitive. It was the exact opposite of the effect of it on corporations. But remember, okay, that for individuals who ran their business through an S corporation, right, what that means is that the individuals owned shares in a C corporation. Now, that C corporation might very well have owned a CFC sort of thing, right? Might have owned the shares in a CFC, but essentially, if an S corp election were made, meaning that it was treated as a pass through, then this is just the result of lobbying, okay, and nothing else. That particular group of people got an exemption, or well, they would say a deferral, but really it's an exemption, from the transition tax. Now, what these tax academics are saying is, well, like, what's the matter with you, buddy? Why didn't you reorganize yourself, so that you had an S corporation? And
Duh.
honestly, even for an academic, that is an indescribably stupid statement. Okay.
Oh, yeah.
Because
Even for academics,
it,
even for academics,
yeah,
right? Yeah.
it completely ignores the fact that other countries have tax laws. I mean, to put it simply, even if you've known about this, right? And it's inconceivable to me. What American abroad is, living in Germany or somewhere or who knows where, sitting around thinking, just close your eyes and imagine this for a minute, everybody. How many US citizens living outside the United States who are trying to set up a business using the corporate form in another country are thinking, well, maybe it would be a good idea for tax planning purposes to actually set up a US corporation to run my local business? Seriously. Okay. Now, so we begin with this is the principle that these people come up with. Now, in fairness to them, like when I read these things they write, I don't think they may realize they're individuals. That's probably a revelation. There are individuals when we talk about, subpart F, the mandatory. But what they don't realize is that there are US citizens living outside the United States. I think a lot of them don't even realize that citizenship taxation exists, or they
I
realize
think you're right. Yeah.
automatically, but that's
Yeah.
about
Yeah.
it.
Right. But not right.
But
Yeah.
even if they have a nephew or oh yeah, God damn it, I have a relative who lives in Greece. Even got a Christmas card from him last year. But you know what they don't realize is the other country might have tax laws too, right?
Yeah. 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 Well, and look, here's really, as you're talking, John, this is really, how can they be so dense? And, it's because they have no stake in it, because it doesn't matter to them. It doesn't matter. It's just a theoretical thing that they write just like any other tax, and that's their product. Their product is commentary on taxes, and the implications don't matter because it doesn't affect them. And so I think, because I would imagine that if it actually affected them, that they'd be able to use their skills pretty well to explain how unfair and unjust this was. But, as it doesn't affect them, hey, you should have done some retroactive tax planning.
No, Anthony, you're being far too charitable. You're really being far, and that's not, one of your.
I know that's not my nature. That's not in my nature. No.
But I've got to, you have to understand why that's too charitable. Okay, it's one thing to do retroactive tax planning, or rather to prepare for a retroactive tax is what you mean more precisely. To plan and prepare for a retroactive tax is what you mean. If you know the tax is coming. Okay, but all right, if you wake up one day, and by the way, when the people woke up, it wasn't the day after the tax was passed on December 22nd, 2016. That was not the day. It was months later.
Yeah.
Right? Because this was not really broadcast, right?
Right.
So this is not about, planning for a tax is coming that's going to apply retroactively. Oh no. This is about planning for a retroactive tax that you don't know is coming until it's already been in existence for 3 months. Okay. It is, not only is it insane, this suggestion, okay, but it is incredibly, incredibly offensive. And it makes me think that anybody who would, make this kind of suggestion is severely disconnected from reality. All right. There's no question about
Yeah. Retroactive planning makes as much sense as non-alcoholic vodka, which with non-alcoholic vodka making a lot more sense. This is you can't do that. You put two things together. Retroactive planning, no, you can't do that. That doesn't work, and it's comically so. And no one stopped these tax academics to say, "What are you doing?" You would think that maybe a copy editor, it could be a student they had help them research it to say, hey, look, I'm just a student here, but what this says is kind of, do you mean to say this?
Well, I mean, let's ask ourselves, why would they say this? Okay, why would they say this? Because, I mean, this is so astonishing and so extraordinary, for sort of the average person who has to live in the world, right, with their feet on the ground. Well, the reason they say this, okay, is because, if you look at the, over the years, this sort of, these rules have been discussed and sort of, rolled out, et cetera. All right, to some degree. Never, by the way, was it certain exactly. I mean, everybody knew that there was going to, that at least with respect to multinationals, there was going to have to be some deal made in return for lowering the corporate taxes, right? Some taxation of these, what they would call accumulated earnings, which they call deferred income, which is, we've talked about this, is not
Yeah.
really deferred.
It's not deferred income. It's not any, it's not theirs. It's
So
not
what
theirs.
they would say is they would point to a paragraph here or there from something from, a government report or the Joint Committee of Taxation, talking about how this might apply to individuals, et cetera, et cetera. And one of the people described in this article, cites a 2022 or 2023 article or something on this. I mean, it's just crazy. I mean, like this stuff, first of all, it's an extremely niche area. I don't even think that many it's such a specialty area that it's just not the kind of thing that, generally I think would be the discussion. You get a bunch of tax academics together. I don't think they would gravitate towards discussion subpart F, and the transition tax because it's such a niche area. But I mean, to imagine that somehow U.S. citizens outside the United States, or even in the United States, but especially outside the United States, should somehow imagine that something as depraved as a retroactive tax on fake income, I'll say it again, a retroactive tax on fake income could be coming to confiscate their non-U.S. assets is almost beyond belief.
Well, I mean, we're all on notice. I mean, I guess we're all on notice that, the government can do anything it wants. It can go back in time, go back in time. So, I guess maybe if you have, shares in any U.S. corporation, be careful. There may be a change that comes that affects you. And now, and I'm looking at this word and I want to go and I really want to spend some time to go over the differences between those individuals in the U.S. and those overseas. But I'm going through this and, the name itself makes no sense. Mandatory repatriation tax. Okay, what was repatriated? Oh, nothing. But the taxes we paid, right? You didn't repatriate this money.
Well,
there's been no repatriation of this money other than the tax being paid. The money is exactly where it is and has been. It's never been distributed to the shareholder at all, and it may never be distributed.
Yeah, on that point, okay, I've read a lot of media articles on this, and these come from respected, journalists that I respect in the area of tax and that. But even they sometimes make the mistake of assuming that this money in actuality was distributed back. Okay.
Well, I would say, John, I think the biggest mistake that, because I know a lot of the authors and I see their writing, I'm reading it all the time. And the mistake they make all the time is they actually believe the tax academics. They actually think the tax academics don't have an agenda and will talk about things fairly. And this seems like an agenda because they're missing, the most glaring, obvious, non sequiturs that should be embarrassing. These should be embarrassing to anyone who said them, and they really should retract their article. I doubt they will. That's where that is the problem that we have, is that these professors who have an incentive to make sure that tax code is as complicated as possible because it gives them job security. It does. They're going to think that these are the objective people, because the taxpayers and their attorneys, well, they're just crazy people who just want to not pay their fair share. But the tax academics, we can handle, we could count on them to tell it like it is. And I think here is the crashing and burning of tax academia here, because I noticed something. There hasn't been any other tax academics to say, who are these idiots? Why did they say this? Guys, retract your
They'll
article.
circle the wagons. Absolutely. They'll circle the wagons. Okay. I mean, this is sort of, and they're not all, I mean, let's not overdo it here. I mean, everybody sort of lives in their own, niche.
Everyone lives in their own bubble, and right. And I would also tell you, my tax professors at Quinnipiac are different, right? They're the different ones because they're my friends and I like them, and they hooded my dad and I at graduation, so I have fond feelings for them. So I don't want to. Yeah, you're right. They're different.
I
So
think that your point that these people are entitled to any deference in their views, any presumption of reasonable,
that's the issue, right?
no,
Yeah,
that they are not. Okay.
they're not.
And frankly, this is almost a new and unprecedented low. I mean, the idea, okay, I mean, thinking this stuff is bad enough. All right. It's just, I mean, thinking what? I mean, let's be clear again. So their view is, that U.S. citizens living outside the United States, running small businesses, an accounting firm, a dry cleaner, a pizza business, a clothes,
Plumber.
that they should have been running their businesses through a U.S. corporation that then makes an election to be an S corporation. Why? In anticipation of a retroactive tax on fake income. I mean, you just can't make this up. All right. That is absolutely crazy. Okay, that is absolutely.
It is absolutely crazy, and I think this is where they just they just lit
That,
themselves on fire.
that's only part of it, right?
Yeah.
That's only part of it. Because let's assume for a moment that it was a reasonable assumption. Let's assume that you buy into the idea that, of course, the first thing every U.S. citizen abroad who's running a small business does every day is calls up their accountant to say, hey, any news on any retroactive taxes on fake income that I should be concerned about? Okay, assuming
Yeah.
that they even do that. Let's say we clear the first hurdle, okay?
Yeah.
The next mistake they make, and this really, I find this one absolutely unconscionable. It's one thing to imagine that there are no U.S. citizens living outside the United States just because it's not on your radar. But these are professors of international tax. Therefore, they should know that other countries have tax laws too. I'll repeat it. Other countries have tax laws too. Now, so let's imagine that. Now, let's go back to our scenario, right? Patriotic U.S. citizen abroad, running a small business, wakes up and does the first thing he does every morning, calls his tax advisor and says, hello, any news? Can you tell me if there's any possibility coming from the U.S. of any retroactive tax on fake income that I've never received? Now, let's say that the tax advisor says, good thing you called me today. I've heard through the grapevine that there's going to be this transition tax coming. You know what? I got this heads up from a lobbyist from the S Corp group who tells me that anybody who runs their businesses through a U.S. S Corp is going to get an exemption from this. And then the patriotic American says, sign me up. Sign me up. How do I get an S Corp? Well, now here's the problem. Do you think now, so shares in a foreign corporation are capital assets from the point of view of the tax systems of other countries, let's say Canada. So do they really believe that the other country is going to let you transfer those assets outside the country to the United States without paying some kind of a tax? No. They're not going to let you do that in the same way the U.S. wouldn't allow that either. So the bottom line here is that we go back and then, okay, so then the patriotic American says, yes, sign me up for an S.
Yeah.
Tax advisor then says, okay, so we'll do that, but you got to understand that if we do this, you're going to have to pay a capital gains tax for transferring those shares outside the country. So here's what I want you to think about. You have a choice. You can pay the US for fake income you've never received, or you can pay another tax in our country where we live in order to achieve this. So my question for you is, are you so patriotic? Are you so patriotic that you want to pay a capital gains tax in Canada or somewhere to avoid this transition tax? Or is it your view that as a good American, you will pay the transition tax?
U.S.
You will set yourself up for double taxation because that's the American way.
American way. That is
All
the
right.
American way.
The
There
point
you go.
is to make this real simple. Okay. Basically, for an American abroad to somehow set up an S corporation is going to have a tax consequence in their country of residence. So it becomes a question of either way you're hit with this. Do you want to pay the tax in your country of residence or do you want to pay the Americans? I mean, this whole notion that this could have been avoided it's batshit crazy. Okay.
Well, the other part of it too is that you probably missed the time to make a S corp election. That if this was passed in December, so let's just say you hear this and you're like, yeah, hey, you need to put in an S corp, and yeah, well, actually, so if you need to go back to time to March, where we can make that S corp election, so if you could do that as well, also get in your time machine, so that you can make the S corp election and then put it in here, because actually you're kind of too late to do the plan.
I think their point is, I think that you always should have had an S corp. I mean, what the hell are you doing?
What are you doing? What are you doing? By the way, and I think that's going to be some good advice going forward. But again, I want to get back to this because I'm looking at your chart here, and I'm looking at, okay, what's the differences between how it taxes U.S. residents versus Americans living outside the United States? Okay, so I look at the first one, same tax treatment whether or not you're a U.S. individual in the U.S. or outside. Okay, same exact thing. Foreign tax credit paid for taxes paid by CFC. Same thing. You're treated the same way. And then if is the U.S. tax when EMP comes deemed repatriation is actually U.S. tax when EMP from deemed repatriation is actually distributed. None here. And then we look at the individuals, same treatment, whether or not you are. Wait a second. Is there any differences between these two?
A huge difference, Anthony. A huge difference.
Okay.
If a 962 election, remember the point of this is, let's back up a minute for listeners. Let's use the example of $1 million of earnings in the foreign corporation.
Okay.
So once you've dealt with the transition tax from a U.S. perspective, those earnings have been taxed forever. They will never be taxed again. If, however, a 962 election is made, and that would be something made by individuals, the effect of that is that those earnings do not have the status of having been taxed forever. Okay.
All right. Okay.
Taxed when the money is distributed. But the advantage is, or a advantage is, that if a dividend is distributed from the company, let's say in Canada, it will be taxed in Canada and it will be taxed again in the United States. So the chances are you might not owe any U.S. tax at that point. But understand that from a U.S. perspective, the corporations are finished with that money. It's been taxed. The individual may or may not have to pay tax on distributions, depending on whether they use the 962 election. Okay. And, conversations I was having with people at this time, I mean, this pushed more and more people into the idea of renunciation, right? And, then the question was net worth and how the exit tax might work. I mean, notice that if you don't use the 962 election, there's a bump up in basis to the amount of the earnings, right? So you might be, it would be less of an exit tax if you were to renounce. Okay. But I mean, let's not get into the weeds too much.
Yeah, that's a little much there, right? But just to clarify, just between these two individual, this section here, it is the same tax treatment whether you are a U.S. resident or living overseas.
Yeah,
A huge difference between how corporations are. So both, no matter what you are, the huge, consequential, complicated, difficult to understand differences. But you are treated as awful whether you're in the U.S. or
Well,
overseas.
from the perspective of the theoretical perspective of using the 962 election, yes. By the way, I think it's a good moment to reinforce the following point. There's absolutely no question. I think that our article demonstrates this very, very strongly. Okay. There's absolutely no question that way more individuals were impacted by this than multinationals. Way more individuals. And I wouldn't be surprised if when the Moore decision comes down, individuals aren't even mentioned, right? And that is proof positive that individuals don't matter. Okay, they don't matter, but that's a different discussion.
That is right. But so our next line, this is where we start to see some differences, whether you're a US resident or whether you're living overseas. So the distribution tax by host country when actually distributed, depending on tax treaty for corporation, often 5% for dividends to parent. Now we get to an individual in the US. It depends on the tax treaty, often 15%. When we have an American overseas, it's fully taxed as a dividend. Treaty benefits not available?
That's right, because of the saving clause. Remember that the purpose of U.S. tax, well, there are a number of purposes to the U.S. tax treaties. But, and I want to say this, and I'm going to say it again and explaining it. This is so Orwell, right? You look at the titles of these treaties and they talk about the avoidance of double taxation, et cetera. But what they don't tell you is that the saving clause in U.S. tax treaties means that U.S. citizens do not get the benefit of the treaty. Okay, there are some exceptions, okay, but they generally will not get the benefit of the treaty. Now, the effect of that is, now listen to me carefully, a principal purpose of U.S. tax treaties is to guarantee double taxation, not to avoid it, but to guarantee it. Okay, and so the effect here is, right, that if you have a resident, a U.S. citizen who's just living in the U.S., they're going to get the treaty right, treaty thing. But let's see. Yeah, I mean, Americans abroad just aren't going to see. The difference is this, right? That a U.S. citizen living in the United States is not a tax resident of the other country, right?
Right. That's
So when a U.S. citizen becomes a tax resident of the other country, they lose a lot of.
Oh, that's what happens. Oh, right on. Wow. It's hard, John, not to think of something called the Equal Protection Clause, But we know the real Constitution of the United States of America is a tax code. So, hey, look, Constitution, you got to bend.
Well,
Look,
that's
you
right.
got to bend all of that because this is important taxation here.
Well, that's right. And, Laura Snyder, right, C President Laura Snyder has written a number of working papers, on this whole issue. And a number of them take a deep dive into the relationship between the Equal Protection Clause and other aspects of the 14th Amendment and Americans abroad. And that is a significant issue. Yeah, I would agree.
All right. So the next line, future U.S. tax rates, right? The corporations got the 21%. God bless them. That's fantastic. Reduced from 35%. Individuals, top tax rate reduced 2.6% for a few years because it's set to go back up to 39.6% through 2025. And it doesn't matter if you live overseas or you're in the U.S. It's the same incredibly high tax rate, much higher rate than the largest corporations on the world pay. Congratulations to you for that. So again, that's the same. This was something, and again, this is something that the tax academics didn't really get into, right? They didn't really explain this part, right?
Well, they're not explaining anything. I mean, they're just taking a cheap shot at individuals.
Yeah, it's like a drive-by. It's like a drive-by, right?
The
Yeah.
other thing they were doing was, I mean, they were ridiculing the Moors. At least some of them.
Yeah.
One of the people mentioned in the article was actually ridiculing the Moors, saying, what's going on? It's a $15,000. Like, suck it up, buddy. What's the matter with you? This is a $15,000 that you're complaining. This is not about
patriotic, right?
This is about the multinationals.
Do your job. Right.
subjected to this. And these people are, I mean, you would think that the theoreticians of the world, and I would call the tax academics, theoreticians, right?
Yes,
You would
yes,
think
yes.
that they would be concerned with the purity of the process and the theory and not stepping outside that, to somehow, make nasty statements about individuals. But this is why I've come to see them as
They
basically,
take it personally, right? It's a personal beef they
take it
have.
personally. That's why this is why I think they're treasury's warriors, basically, right? But anyway,
Uh,
um,
yeah. So now we have future the last line you have. I think we just have this. You have U.S. tax on future distributions, dividends for corporations, 0. That's nice for them. For an individual in the U.S., your tax is a dividend with a credit for host country tax, likely reduced by the treaty. And if you're overseas, well, guess what? We don't have to worry about any of that treaty benefits because you're going to be taxed as a dividend with credit for host country tax. No treaty benefits for you. No, 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 no. Um, so that's a pretty big difference there. So really, you could see, I think what we could see here is how this tax intentionally punished individuals and intentionally punished individuals overseas even more. And meanwhile, we have tax academics not really understanding the issue and actually bitching about taxpayers who don't want to pay taxes on or don't want to pay a retroactive tax on fake income. That's where
well,
they are.
I mean, I think that's right. I think. Look, um, it's very, very difficult to be, charitable towards these people's writings. I mean, it really is. It's just so
Yeah.
offensive on so many different levels. Um, the real problem here, though, is that that as a group, right? Tax academics see tax is very difficult to understand. Okay, for starters, and everybody who's involved in the world of tax, including the tax academics, are permanent students of the theory of taxation.
That's where they make their money. Is the more complicated, the more articles they get to publish, the more interviews they get to have, they're more writing, the more peer-reviewed articles they have. It's all works, and they all work together to support each other. To say, hey, look, we're tax academics, we're treasury's warriors. We got to get together, make sure we're all on the same page, and support each other with all our craziness, no matter how crazy somebody says something. We're just going to back them up. We're not going to mention if they're totally out of their mind. We'll
Well,
just
they don't think they're out of their minds,
no.
right? I mean, I'm trying to comprehend this morning, and so I sent you an email giving sort of like what's really going on here. Sort
Yeah,
of
yeah.
five
I could put that up here.
5 things that occur to me. If you want to put those up,
Yeah, yeah. I put that up there. Yeah. So this is sort of where.
how can this be? How can you explain this, right? How can you
Yeah.
explain
How
this?
are they so dense? Right.
Well, so unaware. Let's use the word unaware and not dense. Okay. I mean, obviously they're highly intelligent people, so it can't be that they're dense. It must be that they're unaware. So my first theory on this is that they just had really no they were clearly aware of the repatriation tax. But if you look at the writings of this stuff over the years, there was almost no acknowledgement that it affected individuals at all. And although they may have been, it's sort of like you have an awareness you should drive with your seatbelt on, or you have an awareness you shouldn't smoke or something, right? But it's not really, front and center. So I think that for them to learn that individuals were affected, I wouldn't say it was necessarily a shock, but I would say, whoa, hadn't thought about that. Okay. So that's the first thing. The second thing is, remember, they're inside the United States, and the
In
United
the little
States
bubble, right? Yep. Yep.
insular country. So when they think of individuals, I mean, they're only thinking of U.S. residents. And, you know, I mean, they don't, so they think about the Moors as a problem. What are these people complaining about a $15,000 tax? I mean, this is crazy. Why shouldn't they pay? Et cetera, et cetera. But they're only thinking about individuals as residents of the United States. So then some of them they may know theoretically that individuals live outside the United States. In other words, they're aware of other countries, right? They have a peripheral awareness. There's a country called France or Canada. But what they're not consciously aware of is that there are US citizens living in those countries who are subjected to a different US tax system and are taxed by the United States. I mean, that would be sort of, oh, yeah, that's right. So it's not something they think about, right? But then let's say they realize there's US citizens, green card, living outside the United States, and they think, well, they might be subject to US taxation. Okay, but what they're not thinking about is that not only are they subject to US, well, of course they should be, they're US citizens, but wait a minute, they're also subject to the tax laws in the country where they live. That's a missing link for them. And it's a clear missing link. Because if you look at these articles, right, I mean, they just don't seem to get that. I mean, the idea, and this is demonstrated by the idea that all an American abroad has to do is set up an S corp, as though there's no tax consequences to that in their country of residence. But really, what it comes down to, we can look at 1, 2, 3, and 4, but really, it ends with 5. They didn't.
Well,
care.
Go ahead, John.
They didn't care. As you point out.
Yeah. Well,
that's how you explain it.
They don't care. They don't care that they don't care. Yeah, that's beautifully stated, John, as always. This is what I would say, and I, we're about wrapped up for time here, and this is where I would say again, who's been punished for not filing and not paying transition tax? Anyone? We don't know. We don't know, that this is something that the IRS doesn't seem to be enforcing, and doesn't seem that they have enforced. They just relied on people to swayed through this, sort this, and they got the money, they ran, right? And now this is where I think we need to sort of get some accountability here for these tax academics who are Treasury's warriors, and I think this is something that's been bugging me lately. I see a lot of people saying that the United States should enter the war in Ukraine, that we should go fight Russia. And I noticed that all these people clamoring that my sons and everyone's child go fight and die for their cause, you know what? They're not so interested in going to the front lines themselves. And so therefore I say, anyone advocating for war must grab a rifle and head to the front lines. Likewise, any tax academic clamoring for more taxes, I think it's only fair that they lead by example. I think it's only fair they lead by example and be subjected to the same thing. And then maybe they would say, oh, wait a second, this doesn't seem so constitutional now, right? And then this is the other thing too, is like we have look, the IRS penalizes like you wouldn't believe. I mean, penalizes like you wouldn't believe. You can get a Form 5471 penalty, a failure to file, even if you're in a coma. The IRS won't necessarily think the fact that you're in a coma is reasonable cause, and that's a fact. And I know that.
Yeah, that's you know why? Because you could have filed the 5471 before you went into the coma.
Right.
That's the reasoning. And
you could have gone back in time to create that S corp to plan. And so, you know what? Hey, tax academics, you got this totally wrong. You're so wrong. It's ridiculous. Therefore, I think because, hey, look, Americans overseas, hey, look, you don't file an FBAR, the IRS can, take half your wealth. I think it's only fair and just, guys. You guys were totally wrong on this. Out of your minds. This is so far away from reasonable cause. I think 50%. It's only fair. It's only fair. 50% of your wealth should be a penalty, including your retirement accounts. I think that is the only way, for people to get the message that when it comes to taxation, hey, you got to be right or else. And hey, look, if you can't understand it, tough. We're just going to seize your wealth because, hey, look, it's all a penalty bonanza for the government because, hey, why not? Well, let's do it. Now, I want to touch on one final subject before we go, and just what you said, because I think there's a great, I like how, I'm not sure who did this in this article, but I really like the what you were mentioning before that, hey, look, a lot more individuals are subject this to than corporations. And, to get to the point here, you guys have extrapolated, okay, well, what's the overall number of filers who have a small business that's not on a Schedule C, Okay. And we get 2.4% of filers with non-schedule C small businesses. Okay. And those would be the people potentially impacted by the transition tax. And so here we go. Here's the bottom line figure, right? 18,900 American nationals living outside the United States were subject to the MRT. Okay, now we're not including everybody inside the US too. There's going to be more individuals on top of that, but we're just strictly talking about American nationals living outside the United States subject to the mandatory repatriation tax. And now it has been reported that there are only 3,231 US multinationals who were affected by a milder MRT. So there it is. The actual facts is this is actually more of an individual tax. This is by far much more of an individual tax than something hitting corporations only. By far, to call it a corporate tax is sort of not really telling the truth. It's sort of misleading people. So I think that's something to be aware of.
Anthony, it should be
go ahead.
called a retroactive tax on the assets of individuals. That's what it should be called.
There it is. And I would love for such a thing to be imposed upon academics. I think that'd be a great idea if we did that. It'd be
I
wonderful.
have a sort of a suggestion on that. I'm not really disagreeing with you, but I'm not really into vengeance as much as I'm into education awareness. I think that
vengeance can educate.
Some kind of an institution needs to be created, which is, in its title, a clear counterweight, to the tax academics. Okay. Same number of people create the same level of influence. So, when you get a tax academic testifying at some government hearing or something, then I think you should be required to have somebody else. Okay.
Right.
Because,
get posted. Right.
This is one more example of, how the very existence of the theoretician and their modus operandi completely distorts the issue. I mean,
exactly.
this is really bad. Okay.
This is really, and we deal with a lot of really bad things. This is really embarrassing.
On a different level. It's almost on another planet.
Yeah. All right. Well, hey, look, we're out of time here. I do want to thank John so much. If you're looking for some help with your renunciation or what to do about your U.S. citizenship, you can reach out to him at citizenshipsolutions@proton.com. Now, Keith is not here, but I do want to give a shout out to the great Keith. He's not here, but you can go to, if you are looking to get in touch with him, here is his email, US_overseas_advocate@outlook.com. And again, I want you to head over to his if you are on Facebook, to head over to his American Expatriates group, join the discussion there. I think he's close to 10,000 people now, all people pretty fired up about what's actually going on. And myself, I'm Anthony Parent. And now this is what I would also say, you know what, that one of my long-standing strategies is that when you're looking for tax strategies, you always want to make sure that you're grabbing a strategy that has a very, very strong lobby. When you look for, life insurance is a great tax shelter. Real estate has, and life insurance has a great lobby. I mean, they exempted life insurance proceeds. That's a very good lobby. Real estate's a good lobby. The like-kind exchange still exists on real estate because that's how strong that lobby is. The 1031 used to be something you could do on any kind of property. That went away in 2017, but the real estate's still there. And likewise, I think what the takeaway, you learn from this one is the S Corp lobby is really strong.
It's
really strong.
Anthony, I think everybody should join the S Corp lobby. They do some great work. But just one final point here as well. I think that this article that we've done, I think it's an important article for Americans abroad generally to read in its entirety. Because sure, it talks about one specific example that has affected a lot of Americans abroad, but the general theme of it is it underscores the contempt that the academic community, Congress, etc., has for Americans abroad generally. You've got the link in there. People can go there, read, download the article, what have you. But I think that generally this is an important article for Americans abroad, and I think they should pay a lot of attention to not only what is going on, but what has gone on.
Well, if you are looking for someone on your side, John is definitely on the side of the individual. Likewise, if you do have an offshore issue that you want to wrap up, you can go to irsmedic.com/offshore, and my team would love to take care of you and help you through your issue. We strongly believe in this, and I really want to thank John so much for his advocacy. This is incredibly strong work, and I want to thank Karen and Laura as well for what they've done and what they helped for us. I want to really thank the community. I think that's one of the upsides of this, is that as we're dealing with this horrible taxation, man, have I been finding some really, really wonderful people that have been impressing me and pushing me to even be better than I am. This is Anthony Parent of Iris Medic. I want to thank you for subscribing, and I'm going to just say, subscribe and turn on those notifications so you know when we're going live so you can participate. This is Anthony Parent again. Thanks for watching.